They call him Dr. Doom. Nouriel Roubini earned that nickname for accurately predicting the global financial crisis. Today, The Economist, a professor at New York University's Stern School of Business and chairman of Roubini Global Economics, has brightened a bit, but he still sees plenty of fragility in economies around the world. He shares his views on the global outlook.
In my view, the labor market is improving more than the Fed expected, and even the Fed has signaled that. And they've already said that if the labor market keeps on surprising on the upside, then rate hikes may occur slightly sooner and slightly faster. The markets are still expecting a first rate hike to occur towards the middle or the second part of the year, but I would not rule out at this point that actually the Fed is going to start hiking already in the second quarter, as early as April or as late as June. I think that if the economy keeps on surprising on the upside, I think a likely scenario, the Fed will be forced to start slightly sooner. The pace of rate normalization is going to be gradual. Probably the Fed funds rate is going to go from 0 towards 1% by the end of 2015, reach a level slightly above 2% by the end of 2016. So it'll be a gradual pace of rate normalization, but the Fed might surprise the market by starting slightly sooner and going slightly faster than they're currently expecting. I think there are risks of another financial crisis, not in the short term, but in the next few years, because monetary policy has been very accommodative, quantitative easing, zero policy rates, forward guidance, credit easing, and all this liquidity has not gone into credit to the real economy, has gone initially in asset reflation that is now becoming asset inflation, asset frothiness, and eventually may lead to asset bubbles and a credit boom that eventually, like before, a boom and a bubble can lead to a bust and a crash. Central banks are telling us, don't worry, because now we have a new tool to deal with financial stability and asset bubble, macroprudential supervision regulation of the financial system, but there is skepticism on whether macropru is going to work. Suppose it doesn't work, then you have a dilemma because you have two goals, economic and financial stability, and you have only one instrument, and damn if you do, and damn if you don't, because if you exit policy rates that are zero slowly because the real economy justifies it, you're going to create the mother of all bubbles. And if you start to try to prick that bubble with monetary policy, you could have a bond market rout or a crash of the real economy. So this is going to be a dilemma that all the major central banks are going to be facing. They have a new role, a new goal, financial stability, but they don't know if they have the tool to deal with it. So the risk is to make new mistakes. There are two extreme views on China. One of a soft landing with growth staying at 7.5 for many years, the official view and the consensus, and the hard landing view of those who believe that it will be a financial, economic, and even political meltdown with growth falling at 3-4%. I'm in between. I think that the consensus is wrong, that China is going to disappoint on the downside. The growth this year is going to be barely 7%, 6.5% next year, below 6%. By 2016, something is not priced in by the market, because the only way China maintains growth above 7% is doubling down every year or another round of credit-fueled fixed investment when the economy slows down. But that means more bad assets in the banks and the shadow banks, more bad investments in real estate, in infrastructure, in industrial capacity, and more bad debts. And now the leverage ratio of China, debt to GDP ratio, private and public, is 220% of GDP and rising. So if the Chinese policymakers are serious about slowing down credit growth, reducing leverage, rebalancing growth from fixed investment to consumption, they have to let the economy to grow below 7%. Otherwise, this credit and leverage bubble eventually is going to lead to a harder landing. So either way, in my view, China is going to slow down more sharply than the market is expecting. Not a real hard landing, but I would call the Chinese landing bumpy and rough landing rather than a soft landing.